At a time when many investors believe they have to choose between cash flow and capital growth, Hotspotting's latest analysis within the Pulse report proves you can still have both. Joining us now in the studio to discuss is Tim Graham from Hotspotting, also the host of the Property Playbook right here on Ticker. Always good to see you, sir.
Likewise, Aaron. Thanks for having me.
All right, let's talk about this report and I guess the overview of where investors are at the moment.
Yeah, I suppose heading back a couple of years ago when interest rates first started to come up, cash flow was king, and that was proven more right than ever. So we developed a report which was for the times essentially, and there was the old adage that you can either have a strong rental yield or you can have capital growth, and we said, well, we believe you can have both. So
why were people having to make a choice?
I think partly because a lot of markets where you could get very strong rental yields were in markets that weren't typically growing, and that certainly changed. When you think about the national vacancy rate right now being at 1%, there's obviously strong demand in rentals, and that's pushing prices up as well. So we targeted locations that we thought would have above 6% rental yields, but also had strong prospects for capital growth.
All right, let's have a look at this Pulse report. We've got the chart up now. So first, what is it? And if you could talk us through these numbers.
So anytime we release a new report, and at the moment we're releasing our winter edition of the 2025 Pulse report, which is the top 50 locations in Australia, 25 housing markets, 25 unit markets, and this is the scorecard from 12 months ago when we first released it. So keep in mind when we created this report, it was the higher rental yield that we're after, but as you can see, we've had some remarkable growth in those markets as well. Aiken Vale in Townsville achieved 40% capital growth when the national market averaged
in
around
12 months, 40%. Wow.
National market averaged about 3%, so we've just beaten that. And then the dollar gain on that market was 170,000. The typical gross rental yield at the time was 6.5%. Midland in the Swan region of Western Australia got 35%, $167,000 gain, 6.3% yield, and they go up to 7-8% in at the time, 7 or 8% in gross rental yields.
What I find interesting, Tim, sorry to interrupt, none of them are in Victoria or New South Wales.
No, you would find very few markets in Victoria have actually performed very well over the last 12 to 18 months. New South Wales has certainly had some good pockets, but we're starting to see Sydney as the one market in the Australian market right now that's actually slipping backwards when Melbourne's starting to show some green shoots.
Why is Sydney slipping backwards?
Well, I think it's an affordability crisis. I mean, it sort of goes through these waves where it has a bit of a boom and then it slows down because people go, we can't afford this anymore.
People got to catch up.
Yeah, exactly right.
And obviously at the moment with interest rates relatively high, they've had a bit of movement as well, but wages certainly not catching up. There's probably going to take a bit of time, which is interesting because you hear from people who've bought properties in regional Victoria, for example, that the values have gone down even in the regions.
Yeah, and look, to be honest, anytime we put a location into a Hotspotting report or the Pulse report for that matter, we always take a long-term growth look. So we still believe that Victoria's got a very strong appetite for growth over the next decade. It's just in a phase now where we've had a lot of government spending, sentiment's been low. We certainly hit an affordability crisis here in Melbourne. But look, your Geelongs, your Ballarats, your Bendigos of the world have got really strong fundamentals, and we think they'll be ripe and ready for a second wind any time.
Yeah, well, Geelong in particular is doing really well too. So the Pulse report, give us a bit of an idea about the past history. How spot on can it be?
Yeah, it's an interesting one. So, as I said, the national market performed at 3% last year, and whilst we had some 35s and 40s, our average across the 50 locations averaged 18%. Now, it's become a lot tougher to go and find those markets again in this edition, just because the growth has come up so high and the rental yields start to lag behind because growth happens a lot faster in the capital growth space than it did in the rental yields. So getting yields that are as high as they were back then is very difficult, but still the top 50 list that we've created in this edition, 2/3 of them are still under $500,000.
So despite, I guess, the bad news about the economy and interest rates and uncertainty, are there still investors out there who are looking at these reports and trying to hunt that place?
Look, right now more than ever. I think, as I mentioned before, sentiment is starting to improve with interest rates coming down, the election behind us, so investor activity is higher today than it has been for many years.
We talk about some of the macro events that are shaping investor appetite for properties, and particularly places like Sydney and Melbourne. Yet we keep hearing about immigration still being high, and many of those immigrants are heading to Sydney and Melbourne. Even immigrants from other states, you could call it interstate migration, which has been a big one for Victoria. Does that overcome concerns about high interest rates?
I would say it overcomes that, but I think what's happening is that where people are choosing to live, and especially you mentioned immigrants coming from overseas, they're actually used to living in, or a lot of these immigrants are used to living in capital cities and living in high density apartments and things. And, over the last couple of years, we've seen this big change in that units are actually starting to outperform houses with capital growth, which has, been, a bit of a paradigm shift for a lot of investors. So we're actually seeing, CoreLogic came out recently and said that 62% of suburbs around Australia, units are actually outperforming houses. Now, if you take that into account, what can I afford in a high interest rate environment? You can actually buy units a lot easier.
That's an incredible turnaround, right? Because we've been talking about a glut in the apartment market in, say, Melbourne, Docklands, too many apartments, not enough people wanting to live there, and you're saying that's actually now turned around.
Well, the headlines went from oversupply to undersupply very quickly.
And also the cost of building means that putting up a tower isn't what it used to be, as well as all of the red tape in a lot of these cities too. Just finally, talk to us about the idea of dual benefit suburbs.
Dual benefit suburbs basically means you can have your cake and eat it too. So I can get good cash flow, which is going to support my investment, not taking money out of my pocket every month, but I can still get strong capital growth at the same time.
All right, sounds good. Wonderful. As always, Tim, appreciate your time, and you can catch Hotspotting and the Property Playbook right here on Ticker. Good to see you, sir.
Likewise, thanks for having me.